Good morning, everybody, and welcome to the second in this series of IMAP webinars, Investing Outside the Mainstream. In this series, what we've looked to do is to look at some of the asset classes and asset investment opportunities that aren't just mainstream listed equities or fixed interest. Yesterday, we had a very interesting discussion between John Julian of Dexus, Michael Karagiannis of Jana, on the challenges of incorporating illiquid investments into managed account portfolios. And today, we're privileged to be joined by Russel Pillemer, the CEO of Pengana Capital, and Zivan Wong of MLC Asset Management, with Paul Saliba as our moderator, to talk about private markets. Before I hand over to Paul to introduce our guests and to take us through today's session, though, let me just talk a little about a couple of the opportunities which we have coming up. Tomorrow, we'll be rounding out this webinar series with a number of portfolio managers talking about the challenges of incorporating alternative investments, non-mainstream investments into managed account portfolios, the way in which they select managers, the way in which they think about incorporating this type of investment into portfolios for retail investors. Looking a little further ahead, in July, we have our Advice in Action conference in both Sydney and Melbourne. In Advice in Action, which really try to draw together the threads of how advice is being transformed. We look at professionalization as an emerging force within advice. And this year, we're going to be looking in particular at the way in which digital technology, digitalization, is transforming the creation and delivery of advice. With our principal sponsor, Centric, we'll be looking at a number of the new technologies that are emerging for advice practices and licensees. If you're in Sydney and Melbourne also, in June, we have a risk management roundtable, at which we'll be drawing together a number of organisations to focus on how they assess, monitor, and manage risk in portfolios. What is risk? How should we be thinking about risk in portfolios? We'll have presentations from Atrium, from Milliman, from BlackRock, and from BT from each of them on the way in which they think about risk and the way in which they assess risk and risk management in managed account portfolios. And finally, before I hand over to Paul, let me just say that the Managed Account Awards are now open. And for those of you who do managed account portfolios, I'd encourage you to participate. Australian equities, small caps, fixed interest, international equities, multi-asset class categories, but also the licensee category. How does your managed account portfolio reflect your investment philosophy? The boutique licensees for those who have fewer than 70 authorized reps, same principle. How does your managed account portfolio reflect your advice philosophy and the innovation and responsible investing categories? We encourage you to ask questions. We encourage you to be engaged with today's presentations and to use the Q&A button to feed through to Paul any questions which may come up. So thanks very much, Paul. It's over to you.
Good afternoon, and thank you, Toby. Today's second instalment of this webinar series, we explore the unconventional investment strategies and opportunities. In this session, we'll delve into the world of private markets, a realm beyond publicly traded stocks and bonds. What are private markets? Private markets encompass a diverse range of investments that aren't readily accessible through traditional exchanges. They included, but are not solely exclusive to, private equity, venture capital, real estate, private debt, private credit, unlisted infrastructure, as well as a range of other assets. So we consider these investments because of the different attributes that they bring to portfolios and reducing the reliance on what public markets does in investment portfolios. We have well-distinguished experts to discuss these topics. Zivan Wong from MLC Private Equity, who's a portfolio manager there, and Russel Pillemer, co-founder and chief executive officer of Pengana. So first of all, we'll get Zivan to talk about his world of private equity, and we'll follow that with Russel and his presentation on his world from Pengana's perspective. Thank you, Zivan.
Well, firstly, Paul and Toby, thank you very much for having me today, and it's great to see so many people on the line. By way of background, my name is Zivan Wong, and I'm a portfolio manager for the MLC's private equity program. I spent virtually most of my career in the PE asset class. I think it's showing my age here, 15 years now and counting, which the past 8 years have been at MLC. And so in terms of my world, my coverage area is our European private equity portfolio. And so we've got investments across most of the sort of major economies in Northern Europe. So if you think the UK, the Nordics, France, Germany, Benelux, quite active in all of those regions. So I guess if there's any questions today from the audience about Europe, I'd be very happy to share a regional perspective. Toby, if we could move on to the next slide. I'll keep this quick, but I guess on the MLCP program itself, it was established in the mid-90s. I guess one of the first super funds to set up a dedicated team, and it's been global since day one. And so we've got diverse exposure across US, Europe, and Asia, including Australia and home territory. We're a team of 10 people with offices in Sydney and New York. So I think originally the program was accessible to members of the Australian public if they had their superannuation with MLC. I think what was pretty exciting about 10 years ago, we began externalizing that capability. So I think the first iteration was the Co-Investment Fund 1 in 2013. We've had 2 follow-ups to those in 2017 and in 2020 off the back of the performance and kind of investor interest. And I think most recently in 2020, we established the MLC Global Private Equity Fund. I guess on the next slide, I guess what we try and describe is the house view or house approach from MLC. And so, private equity is a very large universe, and there are a number of ways and approaches to investing in the asset class. I guess our house approach at MLC is to really partner with private equity firms who have specialist expertise, and we probably think of it in one or two ways. The first one would be sector expertise, and so we've for instance invested in Europe with a PE firm that has invested in healthcare over the past 25 years. They've done 10 pharmaceutical investments, and I think that pattern recognition of doing deal after deal in the same industry is very powerful, and it helps build the domain knowledge. Other pockets of expertise are less about sector expertise and more about certain value creation initiatives. And so one of our UK managers focuses on corporate carve-outs. I guess turning unloved corporate orphans to really great companies that stand on their own 2 feet. I guess another sort of important building block for us is the people behind the business. And so when a PE firm is looking to acquire or partner with an underlying business, I think it's really important for us, for the founder or the family or the management team, to roll over or reinvest their proceeds back into their business. We think that skin in the game and that alignment is very, very important. Maybe if we can move on to the next slide. I guess from a size perspective, I guess MLC, we've got very strong conviction in the mid market as a very fertile ground for transaction and buyout opportunities. And so I think the business which private equity are acquiring in the market, most often they're family owned or founder owned businesses, or they've been owned by a group of senior management for a couple of years, if not decades. And so for these businesses, they're often domestic champions. And we see this a lot in Europe, where whether they're in the UK or Germany, have a great domestic home presence. And I think what they're looking for is a partner in private equity to help make them regional champions. And so they can do that in a couple of ways, such as geographic expansion, product expansion, or through M&A. And so it's really taking those businesses to the next level. And so I think characteristically, these businesses, they often have really great market share in their home country. They have a great brand, but often there's also scope for further value creation. And I think that's the exciting part of that. We can see that journey of that business under private equity ownership or partnership over a period. The next slide, Toby, I won't spend too long, but I think it just kind of brings it to life. And so what we did as a firm, we did a sort of back testing of our portfolio of all our co-investments historically in our co-investment funds. And so this is hard data on investments that we've actually exited and realized, liquidity back to the firm. And so I think what we've observed is that close to 50% of the value creation was wholly due to earnings growth. And so I think that comment about product expansion, international expansion has really flows through the bottom line. I think an important piece of it is as you make a business from a domestic to regional champion, that value of a larger business is recognized at exit by the next buyer, whether it's trade, it's another PE firm, or whether it's an IPO. And so you've seen that increase in the valuation multiple. And so I think it's kind of that proof of concept of the mid-market that really brings that to life. I might conclude just to kind of frame MLC as an organization on the next slide. Just a really quick snapshot of our PE program and how this can be accessed to investors. I think, the first column is accessed by the superannuation fund. The second and third columns are our dedicated private equity products. The middle one is the co-investment funds. So these are closed-end products. We tend to open up to investors every 3 or 4 years. The fourth iteration, so this is co-investment fund 4. We're likely to launch in Q3 or Q4 of this year. The third column, that's what we sort of launched in 2022. That's the Global Private Equity Fund. It's an evergreen product. And if there's any kind of questions after the call, happy to take it online for a one-on-one conversation. With that, I'm going to pause here and pass the microphone back on to Paul.
Terrific. Thank you, Zivan. Now we'll have Russel talk from a slightly different perspective. Russel, obviously at Pengana, is in charge of one LIT, soon to be another LIT that we've just published in the rating in short time. So hopefully that rating will be out soon. Russel, over to you.
Thank you, Paul, and thanks everyone. Appreciate your time today. Moving on to the first slide. Private equity and private credit, or PC and PE, as I'll call them, were once upon a time considered to be alternative asset classes that warranted only small allocations in portfolio construction. This is now all changed, at least at the high end of the institutional market, where they're considered to be mainstream asset classes that command significant allocations. In Australia, the Future Fund has allocations of 15% to PE and 11% to PC. That compares to a 10% allocation to Aussie equities. And in the US, the largest family offices who operate with unconstrained mandates are said to have more than half of their portfolios invested in private market assets. The key reasons for this monumental change in portfolios is the compelling risk-return outcomes generated by both PE and PC relative to traditional asset classes. So including PE and PC in portfolios enables them to be optimized. And I do think that portfolios that exclude these assets will inevitably underperform over time. Unfortunately for retail and high net worth investors in Australia to date, it's historically been extremely difficult to invest in these assets. But fortunately, this has now changed with some best of breed solutions that are now easily accessible for all investors, whether investing directly or through platforms or IMAs or SMAs, etc. This is a game changer for all portfolios. So next slide, please. Many investors think that listed equity markets are reflective of the general economy and that they can provide ample diversification. However, this is not the case. Over the past 2 decades, being in a listed environment has become extremely unattractive for medium-sized corporates due to the costs and complexity of the listed environment. This has resulted in a dramatic shrinkage of the listed market, with the number of listed companies in the US having fallen by more than 50% over the last 2 decades. Today, these markets are dominated by only a handful of mega companies and in concentrated industries such as tech. Conversely, private markets have grown rapidly over the years and are today significantly larger than listed markets in terms of number of companies. Therefore, investing in PE enables investors to truly diversify across the global economy. The evidence is clear that over the last 2 decades, PE has significantly outperformed listed equities and has done so with far lower drawdowns and volatility. It's no wonder that the vast majority of institutional investors include substantial allocations to PE alongside listed equities. Next slide, please. Similar to PE, institutional investment in PC has surged over the past 15 years. The background to PC is that post the GFC, banking regulators became increasingly concerned about the systematic risk to the banking sector and therefore decided to limit the amount that banks would lend to corporates. In order to achieve this outcome, the regulators introduced requirements for banks to hold increased capital to cover their corporate loans. This resulted in the banks largely exiting corporate loans, and this opened up the opportunity for PC funds to capture the market. This has resulted in a supply-demand imbalance, with PC funds being able to earn excessive spreads. The most attractive part of this market is bilateral lending to mid-market companies. Bilateral lending is when the PC firm effectively lends like a bank directly to the corporate in a senior secured position. We at Pengana define the mid-market to be companies with EBITDA of 50 to 100 million, so pretty large companies with billion-dollar type market caps. And here's the incredible thing. A PC fund can lend at a modest LVR to a billion-dollar type company which has lots of cash flows and steady recurring profits, and can charge spreads of 5.5% to 6% over the base rate. So effectively, where rates are today, earning double-digit returns. Due to the nature of these companies, the loss rates are likely to be extremely low. And in addition, as the loans are not traded, there's very little volatility in their valuations. The risk-return outcome is an anomaly that should not exist in an efficient market. It is purely driven by regulatory interference. And this provides investors with the opportunity to earn equity-like returns with low risk and low volatility. It makes sense that PC is currently the most sought-after asset class amongst global institutions and family offices. Next slide, please. So why is it that PE and PC are so compelling? And that why is it that if PC and PE are so compelling that they are not more widespread across individual investor portfolios in Australia? The reason for this is that there are several challenges that need to be overcome. The first of these is diversification. Investors need to be diversified across managers, strategies, sectors, and geography. However, all the best managers have very large minimums, so it's not possible for even the largest investors to get this type of diversification. Secondly, access to the best funds is extremely difficult, as most of these funds are only open to dealing with the investors with whom they have relationships. And finally, and probably most importantly, most of the funds tie investors up for many years, with some taking more than a decade to return capital. So whilst an institutional investor can cope with this level of illiquidity, most individual investors find this untenable. In addition, most platforms cannot easily facilitate such structures. And then there's also the issue of daily pricing, which is required in order to be easily usable on platforms. And daily pricing is virtually non-existent in the private equity and private credit worlds. At Pengana, we have created structures for individual investors that effectively addresses all the challenges for retail investors and high net worth in both PE and PC. These structures are multi-manager vehicles that invest in a wide range of PE and PC managers, thereby providing significant diversification. And our joint venture partners are substantial global allocators who have market presence and relationships that provide access to the best of the best managers. Importantly, our funds are listed vehicles which enable investors to enter and exit on a daily basis, thereby providing illiquidity in an illiquid asset class, as well as daily pricing. As these vehicles are listed on the ASX, they are easily accessible and usable on platforms and can be readily incorporated into IMAs and SMAs. In private equity, we have a vehicle with a ticker PE1, which is circa a $460 million vehicle, which we listed in 2019. And in private credit, you might have read in the press that we are in the process of an IPO for a an entity, a listed investment trust with the ticker PCX, which opens up on May 20th with a target raising of 250 million. Notably, PCX has an innovative structure that should, in our view, minimizes the chances that its units will trade on market at a discount to net asset value. Listed vehicles are indeed game changers for individual investors who now have the ability to totally rethink their portfolios to include substantial allocations to PC and PE, and be rewarded with both higher returns as well as lower volatility. Paul, back to you.
Terrific, and thank you. This is an interesting space, and we've got quite a lot of different opportunity sets, different ways that managers and investment solution providers are trying to resolve and provide solutions in this space. One of the things that is interesting is this space has probably got some terminology that not everyone is familiar. General partners, co-investment, primaries, secondaries. These are terms used in this space. Perhaps, Zivan, before we get into some of the details and other questions that might come through, perhaps we can talk about some of these terminologies and what that means from an investment perspective and from the investor's perspective in terms of when they're looking at the opportunity set. So Zivan, perhaps if you want to address that first, and then I might pass over to Russel to see what he has to say on it and how they
absolutely.
think about it.
All happy to help. I think sometimes private equity is a bit of a black box, so if we can, demystify it to the extent possible, I think that's great. So I think from a starting point, when we talk about general partners, these are the private equity firms themselves who are acquiring companies and driving the value creation. The limited partners can be a range of different institutions. You've got a mix of super funds in Australia. You've got the pension funds in the US and Europe, as well as a mix of family offices and institutional investors. And so those are the limited partners. Often when a GP or a PE firm, they're looking to raise a fund, and for argument's sake, they might be looking to raise a $500 million fund. You'd have a range of different investors committing 20 million, 30 million, 40 million as limited partners into this vehicle. Usually that fundraising process probably takes about 12 to 18 months, probably a bit longer in this current environment. And then they raise the 500 million. What they usually find is if that sort of fund, they'll invest in 8 to 10 portfolio companies. And so for each of those portfolio companies, our capital will be drawn over time. Usually it's an investment period of 5 years. And I guess the ideal goal is in the years 6 to year 10 of that fund life, these businesses will be effectively exited or sold to the next party. And our underwriting goal is a 2 times return on our capital. And so that's on the fund investment side. I think the co-investments, that concept is if a PE firm finds a fund investment for their portfolio, so a portfolio company, well, I guess we've got the opportunity to double down and also co-invest alongside. So in addition to our pro rata fund investment, we're also committing co-investment dollars directly to that portfolio company itself. And so the PE firm will continue to manage our capital and drive the value creation, but we sit alongside themselves as a partner. And so we like to think about our co-investments as the best picks. I guess the third piece and the third concept is secondaries. And so usually it could be a limited partner, such as ourselves, who holds a stake in a fund investment, selling our fund interest to another limited partner, either existing or not a partner of the current PE firm. So that's a secondary market. I hope I've demystified slightly, Paul, but I'll pause here.
And just before you finish,
Sure.
what parts do you do co-investment? Are investors in your fund getting access to primaries, secondaries, and how does that help? Do you use general partners or limited partners or both, and how does that help?
Yeah, so that's right. So MLC, so we are a limited partner, and so that's our role in terms of asset management. We do a mix of both, and so we do fund investments and co-investments. The fund investment piece have been investing since 1997. The co-investment piece since 2007. So we do a mix of all of the above.
Terrific. And Russel, on your side, on your private equity side, I'm aware that you have a combination of fund managers and direct investments and so forth. Do you want to explain some of these terms, how they play in particularly your private equity fund, but also how they might be involved on the private debt side?
Yes, so in our private equity fund PE1, we have a mixture of primaries, secondaries, and co-investments, the same as Zivan was talking about. And it's good to get a balance amongst those. They all have different return profiles and a different duration associated with them. For us, what's really important about our vehicle is that it's an evergreen vehicle. So once you invested, you don't have to sell out. We call all your money up front, so you're not subject to a capital call period. You get to invest everything up front, and then because they're listed vehicles, you get to sell out of the vehicles on market at whatever point in time you'd like to sell out. What that means is that we have to deal with the cash flows in the interim. So we don't leave it up to our investors to have to deal with capital calls, to have to hold money in the bank waiting to fund future capital calls, etc. Our investors get the opportunity to put all their money in on day one and get their money out whenever they feel the time is right. So we take away a lot of that complexity and task away from our investors. And also, when our investors think about the return that they're getting from us, they don't have to try and calculate, so what is my blended return of the money that I've kept in the bank and the money that's actually being called down and put into the funds. With us, everything is invested, and what you see is what you get.
Terrific, thank you. So one of the questions I've got is, how do you access high quality global PE opportunities? My understanding is that, you know, if you're a European investor or indeed in the US, there's a pretty broad range of opportunity set, even into the retail market or the advised market. Australia, it's a little bit more challenging. How do you access high quality global PE? Zivan, perhaps you first off.
Yeah, Paul, it's a good question. I think, you know, geographically, we're a large island in the middle of the Pacific. You know, the major PE hubs of the US and Europe, you know, they're a fair distance. I think it's probably a combination of I guess, two different considerations. I think one is inbound approaches from PE firms reaching out to MLC, and the converse is outbound work from our team trying to find the hidden gem in that PE universe. I think in terms of inbound interest, it's fair to say there's a lot of interest from overseas PE firms looking to access capital in Australia. I think just by virtue of our super system, and don't quote me on this one, Paul, but I think we're top 5. I think it's north of 3.5 trillion. And so I think there's a very clear recognition that Australia's kind of an important tentpole for them to get access to Asia Pacific investor base. I think what I've observed over the past couple of years, I think 6 or 7 years ago, was mostly the top end of town. So you get very, very large PE firms who have the resources coming down to Australia every now and then to speak to a number of the different super funds. I think what's changed now over the past 2 or 3 years, and this is kind of post-COVID and travel restrictions, PE firms of all different shapes and sizes are coming down to Australia on a regular basis, visiting Sydney, Melbourne, Adelaide, Perth, Brisbane, and so forth. And so I think, you know, just the other day I had a very niche UK firm that focuses purely on healthcare technology coming into our office for a meeting, and so that's becoming more prevalent. I think, secondly, we spend a lot of time as a firm, like having boots on the ground, meeting PE firms in their home territory. And so for myself, I'm usually in London a couple of times a year, or if not other parts of Europe, flying out to Berlin in a couple of weeks. And I think it's just very important to maintain that dialogue. And so I think it's important to build that relationship over a couple of years before formally adding a firm to the portfolio. I think that kind of pre-work is really, really important. So if I could probably summarize, I think the volume of investment opportunities and that deal flow is strong. I like to describe it as drinking from a fire hose. I think the focus is ensuring that really sort of appropriately screening and filtering those investment opportunities and getting the sort of the best picks for our investors. So it's, you know, it's a bit of both, really, Paul.
Terrific. And Russell, is there anything different that you guys do within your vehicles?
Yes, it is different for us. So we focus both in private equity and private credit on the mid-market. So the mid-market, I mentioned in talking about private credit, is companies with $50 million of EBITDA to $250 million of EBITDA. So sort of in Australia, they'd be large companies. Over in the US and Europe, they're medium-sized companies. The difference, those companies are traditionally invested in by mid-market private equity firms. So if you're a very large private equity firm, you've got tens of billions of dollars in your portfolios, then you don't go invest in companies that might be worth $1 or $2 billion. So you try and invest in much larger companies. So we're looking for those smaller firms those specialized firms. And the reason why we do this is because we find that the returns in the the returns in the mid-market for both PE and PC are much better than at the larger end of the market. And they also, on a risk-adjusted basis, are better than the small end of the market. So that's where we like to invest. Those funds, those mid-market specialists are really hard to access. It's not generally known who they are. You really need to be in the know. And also a lot of them are capacity constrained. So the only way of getting access to them is to do a joint venture with somebody who really has that right global access. So what we've done in private equity, we have a joint venture with a group called GCM Grosvenor out of Chicago, which are one of the leading allocators in private equity. And in the private credit space, our partners are Mercer, who's one of the largest allocators in the world, a big business in private credit. So it's through our relationships with them that we get this access. Without those relationships, we would not be able to get this type of access.
Sure. One of the questions, and I'll get to the question in a moment, but there is an observation that the differences in returns can be quite substantial. I know they talk about vintages of private equity, private debt. There is a question specifically around this, and I'll read it out for the audience. According to Morningstar data, performance difference between MLC co-investment funds 2 and 3 over the past 3 years is stark at minus 7.7% per annum versus 118% per annum. Now, 118% per annum sounds very high, but regardless, is this about vintages and different times in the market? And if that's the case, how does your solutions kind of resolve that for investors and help them not have to worry about whether they buy private equity vintage this year, an older vintage, and if so, what age? Perhaps Zivan, given it's an MLC question specifically, and if you can't answer it, take it offline and we can actually answer the specifics of those two funds later. But if you can, please do. And otherwise, if you can address that kind of different vintages, very different returns, depending on when you get in and what solutions you buy.
No, Paul, thank you for the question from the audience. I think, so for clarity, the co-investment fund 2, that's a 2017 vintage. Fund 3 is a 2020 vintage. And so I guess some of the drivers of that variance. So for 2017 vintage, we deploy the capital over a 3-year period. So 2018, 2019, 2020. I think when you get to now in 2024, you're seeing really interesting things because the companies that the PE firms have owned over this couple of years, a lot of the value creation is really coming to fruition in terms of international expansion, product expansion, and so that revenue or earnings growth you really starting to accelerate. And so often these PE firms, they're laying the groundwork over those first couple of years. And so I think now you're seeing exits, distributions, dividends back to investors such as ourselves, and that's driving the performance. If I roll forward to co-investment fund 3, which is a 2020 vintage, it's still really in the investment phase. So 21, 22, 23, I think we're close to 80%, if not 85% invested. And the investments are in the ground. So there's 2 or 3 more years of really building the value creation, building the platform. And what we'd like to think is over the next couple of years, you'll see the same sort of performance play out for co-investment fund 3 as we're seeing for co-investment fund 2. I think the broader question about vintage year diversification, absolutely, that is very, very important. I think private equity, it's a long-term asset class, and I think it's important to invest through the cycle. I think that classic sort of terminology of time in the market is more important than time in the market. That's absolutely true. If I think back to COVID in 2020, early 2020, when a lot of people thinking the world was ending, what we've seen is 2020 and 2021, some of the strongest years we've had from a returns and performance perspective. Those 2 years throw up some really interesting buyout opportunities in terms of buying companies at really attractive valuations. So I think for us, that diversification, whether it's vintage year, sector, geography, is quite important.
And for us, Paul, we handle this all internally. So investors don't need to worry about what vintages they're in. We give them allocations across a whole range of vintages. So we diversify them across vintages. We have highly diversified portfolios that are really trying to give investors the experience of private equity, of top-tier private equity in general, and top-tier private credit in general over time. So in private credit, in private equity, We have more than 450 underlying investments if you look through our funds and through our co-investments. And in private credit, we have more than 2,000 underlying loans that we're invested in. So highly diversified, not just across names, not just across funds, but vintages as well.
So correct me if I'm wrong. So what you're saying there, and this is both of you, is because you have different vintages. You've got early phase where you've just invested, and obviously until you revalue the asset, there is basically no return. But you're also realizing assets at different points in time, so that gives you a, I suppose, smoother, but certainly you're not waiting for time to elapse 3, 4, 5 years before the returns come through and you realize assets at that point.
That is a factor, but also we need to recognize that certain vintages do better than other vintages. So you can imagine if you invested pre the GFC versus investing post the GFC, etc., there would be significant difference in return profile, and it can be 5 to 10% type return differentials. That can be very significant. So as I said, for what we're trying to do, we don't want to put investors through that guessing game. So we give them diversification, so they've got everything through the cycle. And you can have diversification from having invested in funds over time, but also you can get what we call backward diversification through the secondary market. So we can actually go into the secondary market, buy old vintages, and that helps in the vintage diversification as well. So we concentrate a lot on this. And this is especially the case for private equity. Private credit, it's not so much an issue because the average duration of loans in private credit is only 2.5 to 3 years. So they turn around quite quickly. So you don't have that big diversification vintage issue. But in private equity, you certainly do.
Terrific. I suppose there's a question here, and this is not from the audience, but around valuation and I suppose, particularly with Pengana being an LIC, is discount to NAV. So, firstly, valuation of these assets, they're private assets. How do you look at valuation, and who's doing that valuation, and what assurances do we have as investors that my carrying value of my unit trust or LIC is roughly reflective of that valuation? And then what do investors expect, or what can they expect around the discount to NAV, particularly around the listed solution? So perhaps, Zivan, on your product, how are underlying assets valued? How can we be reliant on those values and confident that that's where they're at? And then is the realization of assets reflective of those values, or do you get a large kicker on realization generally?
Yep, Paul, it's a good question. I think it's one. I think valuations. It's critical that we're aligned as a limited partner with the general partner or PE firm, and so I think by convention and practice in the industry, for PE firms, the evaluations occur on a quarterly basis. And so we'll have a look through to the line by line portfolio companies. Myself and all the portfolio managers in the team quite scrutinize this quite heavily in terms of whether it's your market in terms of market to sort of listed multiples, discounted cash flow, as well as trading multiples, and recent transactions, all the above. I think in between those sort of quarterly cycles, we have a bilateral dialogue of every private equity firm we're investors in, and that to us is really, really important to be able to pick up the phone and have a discussion about the valuation. I think a lot of the headlines you receive about in the venture capital space in terms of we're looking at some businesses that somebody's invented in their garage. It's a 22-year-old like Mark Zuckerberg back in the day, where it's a product that nobody else has seen in the market. And I guess how do you value a business like that where it's based on user numbers? I think I guess our core building off for ourselves is the mid-market, where there's established businesses, there's clear revenue, there's clear earnings, and there's clear kind of precedent data to work on. So that's really, really important. To answer kind of the second point of your question in terms of how we think about the value methodology and the valuation approach, in addition to the investment team, we have an in-house operation team who scrutinize the line by lines, and so it's quite a detailed, very exhaustive process. And I think it's not only just right governance importance, it's in terms of alignment to make sure that the valuations are being treated appropriately. You do see a slight valuation, I guess on balance, we do see a valuation increase on exit, but I think that's more about a testament when these PE firms are taking these businesses to exit or market, there's strong interest. So they're running an auction process where there's interest from financial sponsors, from trade players. And so I think it's just reflective of they've taken this business from A to B. It's a larger business, and that's just generating interest. And I think that's just a function of the next buyer to really secure the asset.
Terrific. And Russell, I expect your answers largely the same. If there is any difference, certainly address that, but also around the potential discounts to NAV, if you can talk to that.
Sure. So yes, very much the same as what Zivan was going through, and certainly our partners being Grosvenor and Mercer, conduct extensive interviews, exercises around NAVs, but it's a very well regulated market, and we also don't have any meaningful allocations to startup style businesses which have these wild valuation fluctuations. With regards to discount to NAV, so this is obviously a critical issue in that liquidity is keenly sought by all investors, but the flip side of this, and listed vehicle can give you liquidity. The flip side of this is that sometimes they can trade at discounts to NAV. We've done two things. So firstly, in our older vehicle, which is P1, that's generally over time, the average is traded pretty close to the NAV over time, although there's been times in the marketplace when a gap has developed. And the only way to effectively deal with that is to really get out and market the stock and get it into the hands of new investors, get excitement about the stock, etc. But it can gap at certain points in time. So that is something that you need to keep your mind on. You need to have a lot of marketing and distribution support behind these products. You'll find in general in the listed market, whether it's LICs or LITs, like our vehicles, those fund managers who do not market them hard, they usually suffer from perpetual discounts to their stock. So that's on the discount. What we've for P1, what we have done with PCX, which is our private credit vehicle, is we've put together a new structure that we've worked hard with the ASX over the past several months to create. And this structure should effectively deal with the discount to NAV and should ensure that there won't be a discount to NAV. So what we've done is when investors are best be described like this, when investors want to exit, they've got two options. Either they can sell on market, or alternatively, if they don't like the price that they're getting on market, they can put in a redemption request. This redemption request kind of looks like what an unlisted fund, how a quarterly redemption unlisted fund would work. So you put in your redemption before the start of the quarter, and you'll get paid your redemption at the end of the quarter, which will include both the NAV from the beginning of the quarter plus the return for the quarter. And that's done at the NAV, as I said. So because you can get out by putting a redemption request at the NAV, why would you sell at a cheaper price on market? And if there's an urgency and you need to sell on market immediately, we would imagine that there'll be other investors who'd be happy to pick it up at 99 cents in the dollar, and they can just arb the redemption. So we think that this is an effective way of dealing with the discount to NAV, and we think that this will actually become the new standard in the market going forward. And I'm looking forward to showing over time how this does work and really giving investors confidence that they do have the liquidity in the underlying.
Terrific. We've got another question from the audience, and I suppose this goes to the sort of businesses that you've spoken about at a general level. Given the businesses are making profits generally or hopefully, why do PE funds in general pay little or no regular dividends or distributions to the end investors? I'm not sure, perhaps from both perspectives. Russell, you go first, you're off mute.
So the PE funds themselves are constantly figuring out how to deal with their cash flows. So what you usually find is for the first part of their lives, they have an investment period where they're investing They're not returning anything back to investors. And by the way, the same thing applies to private credit. Over time, they will start getting back returns to investors once they've invested. If dividends come through, if recaps come through, if sales come through, they will start getting that money back to investors. But this is very sporadic, right? It's not a consistent return. Most of the underlying businesses, would be using their dividends potentially to pay down a debt, etc., etc. So there's no consistency with this. But in general, there actually is quite a large amount of cash flows coming back from these underlying investments. So you can't pick any single manager or any single investment and know what the returns will be. But in general, you do know that there is money coming back sporadically. What we do in our funds, because we've got so many investments, we're able to experience on a more statistical, or expect on a statistical type basis that there will be cash flows. And so we do actually pay yields. So in our private equity fund, PE1, we actually pay a 4% yearly yield to investors, because we know on average, at least that money will be coming back. And that's net of what we have to invest in future funds, etc. In private credit, we pay at least a 7% yield, and we actually pay that on a monthly basis. So 1/12 of 7% every month. And we know we can do that in private credit, because in private credit, there's a lot of yield that's been generated that is predominantly a yield asset. So that's how we deal with things. And as I said, it's a bit of a misunderstanding that there's no cash flows at all in these industries. It's just they're sporadic, and from time to time, you won't have any from specific investments.
So, Zivan, I assume a lot of the businesses that you're investing in, whilst they do make profit, and maybe not all of them do, so you could talk to that firstly, but whilst they do make profit, a lot of them are reinvesting in the business as they're growing and going from the private market to some sort of bigger and better, maybe listed or owned by new owners, trade, sale at a later point in time. And so that is perhaps why distributions are a little lower. Of course, as a unit trust, any distributions, dividends that you receive, you do have to pass through investors. So perhaps talk to it from your perspective.
Yeah, I think echo Russell's sentiments in terms of often these businesses that are owned by private equity or partnered with private equity, they're very cash flow generative. And I guess one of our 101 filters is that the businesses need to generate cash flow for one. I think the other piece is there's a bit of a push and pull of how do you use these cash flows. And so we are co-investors in a European consumer staples business, which spins us with a lot of cash. It's fairly cash flow generative. It's a push and pull of the management team, the private firm, is like, how do we use this cash flow? And so what this company has done over the past 5 years is use those cash flows to expand the factory floor, to use some of the cash to engage in acquisitions, international expansion, quite productive source of that cash flow to really reinvest in this business. And the EBITDA has doubled in 6 years, and it's been the growth has been quite remarkable. I think equally, we have a number of projects in the portfolio where the company, if it's the right strategic decision, they'll perform a dividend recapitalization 2 or 3 years in, where some proceeds will be returned back to investors such as ourselves. And so it is no one size fits all, but often for these firms, you also need a little bit of defensibility of just to preserve cash flows, as we've seen in this high interest rate environment over the past 18 months, to be able to weather that storm of high interest rates. So but we certainly see that. But I think the fundamental sort of screen for us is that the business needs to be cash flow generative in its own right.
Terrific. One of the interesting things is, a lot of PE we talk about and hear about is international. Is there an opportunity set in the local Australian market? Is that something that either of you invest in, or are they too small, or there's not enough opportunities that by the time they get through your filters and screens, they're simply just not good enough? If you could talk to that, that would be great.
So Australia is obviously a very small part of the world. So I think it's probably 2% or so of the world's investments in private equity, probably even less. So yes, it's possible to invest here, but it's not likely that we'd find investments or managers who invest in Australia. We also find that the markets, with what we do in the mid-market, the offshore markets are better than better than the Australian marketplace. And the key reason for that is that in the Australian marketplace, it's quite easy to list a company that might be a $500 million or $1 billion type company. The ASX is very welcoming of those companies. In the US market, it's hard to be listed if you less than a couple of $1 billion of market cap. It's very expensive. You have to do quarterly reporting, which is an atrocious way to have to run your business from quarter to quarter. It's just generally a difficult environment to be listed. So what you find is that most of the corporates, the mid-size or even mid to large-size corporates in the US, in terms of how we would think about size in Australian terms, so $1 billion type company would not be looking for listed capital; they'd be looking for unlisted money. And so there's an abundance of those in those markets. In Australia, there's far fewer opportunities, and there's a lot of fund managers or private equity managers in Australia, and they are good managers. But you find that a lot of the competition is fierce over here. Very rarely do you find one-on-one deals that aren't competitive, but it's quite different in those markets. I think the returns we're likely to see out of those markets on balance will be better than you see from the Australian firms. Just might mention private credit, which is the other asset class which we had discussed, and there the offshore markets are far better than the Australian marketplace for what we do. So I mentioned we do mid-market investing. And in the US markets, the banks don't lend to the mid-market. The regulators have prevented them from doing that. And so you find the private equity firms have that space open to themselves. In Australia, what you find is that lending to $1 billion type companies, bread and butter for our banks. So the private credit firms here have to compete against the banks, and the banks operate with much lower spreads, maybe 2.5% versus 5.5 or 6%. So the spreads in Australia are much tighter for mid-market lending, and that's why you find most of the Australian private credit opportunities revolve around leveraged property or property development, or maybe smaller companies, etc. But that mid-market opportunity really doesn't exist in Australia.
Terrific. And Zivan, what's your experience, and do you invest in the Australian market, and is there enough meaningful opportunities there?
Yeah, absolutely. I think MLC, we have a slightly sort of different perspective. I think Australia being our home market, we do have long-term relationships with a number of local PE firms, some of which we've invested since the mid 2000s, and we've recommitted to their fundraisers every 3 or 4 years. And I think for those managers or those PE firms, they had stable, consistent track records, and we continue to back them. I think to Russell's point is right. Is relative to the size of our economy, there are quite a number of PE firms. It's a very competitive market, and so having conviction to back the firm, that requires a lot of work and sort of manager selection. I think just generally, Australia has a lot of parallels with economies in Europe, such as the UK or Sweden or Denmark, insofar as a very supportive business environment for private equity. There's a strong rule of law. It's really relatively transparent access to information. And in terms of regulatory approvals, quote unquote, relatively sort of smooth process, and a mix of exciting industries and sectors. If I think about our co-investment portfolio, it's quite diverse in Australia. We've invested in HR, payroll software, through to mobility products for the elderly. Investment we made at the second half of last year was sort of alarm signaling communications technologies, and so like a number of different European economies, some really interesting mid-market family founder-owned businesses that are looking to take that next sort of leap in their growth. And so to answer your question, yes, we're quite active in Australia as well. It is a building block of our portfolio.
Terrific. What are the current themes or focus areas that you're currently looking at, Zivan?
Yeah, it's one we always talk about with our team and an investment committee, and what's on our mind. I think, I think we've come through a really interesting period in terms of COVID, Ukraine, macroeconomic policy. I think there's still a bit of steam left of inflation, but I think the pace of central bank rate increases, that is tapering off slightly. A bit of an open question about RBA, does it go up, go down? But I think a little bit of sort of normality has returned to the market. I think that's brought some sort of clarity in terms of deal flow, and we're certainly seeing deal flow pick up over Q4 and then through to Q1 this year. I think there are, I guess, a number of secular themes across our portfolio, regardless of geographies, that are capturing our attention. I think one is that convergence of healthcare and technology, and so how do you deliver healthcare to people in a smarter and more cost-efficient manner? There's a lot of healthcare data out there, but how do you harness that in a way that's practical and meaningful? And so I guess we're investors in a health tech software business that's helped businesses sort of manage their hospital ordering and inventory. And so there's pockets there we're seeing that sort of deal flow really increasing. I think the other one is energy transition. I think as we increasingly move towards sort of renewable energy, that energy transition in a number of geographies is maturing. And so beyond just solar panels and EV chargers in the home, I think for 5 to 10 years, that industry was still in kind of proof of concept stage, particularly in the UK. That transition is really speeding up, and so we're seeing PE becoming a lot more active. I think the third one that's on everybody's mind, over the past years is AI, and I think for us, it's maybe not necessarily investing in AI directly, but like how do PE firms utilize that AI to create better investment decisions or to help with their value creation plan? And so I think I was speaking to a firm a couple of nights ago, and they were talking about a software tool which they use, which kind of is a visualization of workflow mapping. And what the gentleman showed on the screen was almost a spaghetti map of different business divisions talking to another in one of their portfolio companies. And so they use this tool to help streamline, go, where are the where are the pinch points or where are the bottlenecks in the decision making? And then it showed me the after in terms of it wasn't a spaghetti map anymore, it was a straight sort of workflow tool from one division to another. So I think it's those kind of AI tools I think are going to become more prevalent within the PE industry, but we're pretty excited to see what the future holds.
Terrific.
So for us in private equity, as I said, we're very diversified. Private equity is a very long-term game. We're going into fund now. We might be in there for 10 years. Anything can happen over that time. I think all those themes that Zivan mentioned, that all those are good type of themes that that come across our portfolios. But we don't tilt the portfolio too much in terms of any one sort of theme or any one opportunity. We really want to invest with the best managers who have the best opportunities in their specific space. Most of our managers are sector-specific managers and really understand their spaces and will go where they need to go in their spaces over the next decade. I might just actually switch it to private credit because that is interesting at the moment. So private credit at the moment, what we're finding, I mentioned that lending to the bid market has traditionally been a sort of 5.5% to 6% spread over base rates. But what we're finding at the moment is those spreads are even higher. So you find in times of stress in the market, you find there's a lot of companies who have borrowed money when rates were low, and now rates are higher. They're struggling to recap, etc. And so there's a lot of opportunity around in the marketplace. We're finding that the demand for private credit capital dramatically exceeds the supply. And even though money is coming into private credit, it can't keep pace with the amounts of money that is being required just for refinancing. And then there's also private equity firms who've got a lot of dry powder who need private credit to help them in their acquisitions, etc. So we find that's a particularly interesting space at the moment, and those spreads are even at the higher end of the range, and even above that. And we think that will exist for for the next several years because of the supply-demand imbalance.
Yeah, it's definitely an interesting market. Certainly at SQM Research, we're seeing a great deal of opportunity in terms of managers coming to us looking for ratings in the private debt side or private credit. A lot of that is actually Australian based, and I suppose so some of those managers are really focusing on largely on property, but those short-term loans, 2 to 3 years, like you said, Russell, in the Australian market, probably doing loans that are a bit smaller than the sorts you're talking about. So you're probably more institutional level than what some of the managers we're seeing. And I think the opportunity set for investors is actually quite broad. You can be, first mortgage only. You can have first mortgage with, other types of mezzanine debt and other things, but predominantly first mortgage, or you can have much more diverse. And then with your soon to be released LIC, that brings a grander scale, I suppose, in the debt side, larger loans, larger organisations. I get a sense that there is a lot of borrowing from fairly well-funded individuals or groups. Is there a risk in this space that, these interest rates finally bite, demand, and the consumer finally, capitulates and reins in, we go into some sort of economic weakness? Is there some challenges here in this market? What are your thoughts on that, Russell?
I think, are you saying just sort of too much capital chasing, or are you talking about going into a recessionary environment?
Yeah, I'm talking about on the credit risk, and perhaps the rates that we've got now become too demanding for borrowers as issues happen in the market, whether it's in the property market or consumption, and we all go into some sort of recession or near recession conditions.
Yeah, so I don't we don't deal in the Australian property market, and I think it's got its own set of risks, and I think a lot of that is determined by the prices of properties, potential LVR issues, etc.
Sure.
So I think that's got completely its own factors to deal with. What we're doing is corporate lending to large companies, with lots of cash flows and lots of recurring earnings in sort of protected type environments, so good solid businesses. If you lend to them at modest LVRs, the chances of them falling over and not being able to pay back their loans are tiny. It's really, it's very, very rare that a solid $1 billion type company falls over. So that's why we like that particular end of the market. But I think you'll certainly find, potentially at other end of the markets, maybe small companies, maybe there's an issue there. That might eventuate, with lending to small companies or lending with too high LVRs, right? So if you're lending too much money, you're over-gearing companies on the basis you might think rates are going to come down, but they don't, etc. Then that's a problem. I do think that private credit in general has an advantage at the moment because a lot of this lending, I mentioned the average loan is only 2.5 to 3 years in duration. So a lot of the lending that has actually happened over the last couple of years. And it's happened in an environment where people knew there were issues and there were, higher rates were coming, etc. So I think they're actually, most of the good private credit firms are very well set up at the moment to actually cope with this sort of environment.
Terrific. Thank you. And thank you to our audience today. Thank you, Zivan, and thank you, Russell. Some great insights there. I'll hand back to Toby. Thank you all.
No, thank you. Look, I found this a fascinating topic today, and one which we covered really well. Russell and Zivan, thank you so much for taking the time to go through the complexities in a good deal of detail in both private credit and private equity. I found it fascinating. So let me just remind you that tomorrow we have, where's our little, that's interesting. Yeah, right. Let me just share my screen with you and remind you that tomorrow we have Lachlan Brumby from Russel and Jason Petrus from Resonant Asset Management talking with Chetan Trahan from SQM about assessing investment management in these non-mainstream areas and the role that they see illiquid investments, private market investments and alternatives play in portfolio construction. And then again, as I said, advice in action, risk management roundtable, which we'll be promoting in the next few days, and the awards, if that's something that's relevant to you. So Paul, Saliba, Russell, Pillemer, Zivan, Wong, thank you so much for today, and we look forward to having you all join us again tomorrow. Thanks very much.
Thanks all.